What is inventory and how does it work? Inventory is a process of keeping a product, raw materials, and raw ingredient to fulfill a company minimum production quota. This inventory is also one of the largest account in balance sheet. There are several valuation methods used to calculate the total value of inventory owned by a company at any particular time. First is FIFO method, first in, first out. Second is LIFO method, last in, first out. Third is weighted average cost method. And fourth is specific identification method. Part of inventory cycle has a close link with the purchasing cycle and sales cycle. This is why this cycle is the most complex and unique among any other cycles. The reason why inventory is a complex and time-consuming is because these three main points. Firstly, inventory is often moved into different locations, making a physical control would be difficult. Secondly, is because inventory usually consists of diversity of items, goods, merchandise, and materials. Third is because the valuation when there is obsolescence. This is to recognize the fall in value and to be written down in the financial statements. The execution of inventory and warehousing cycle and their audit objective. First is existence, to ensure whether the inventory on balance sheet generally exists and if the inventory transaction occurred as the reporting data. Right and obligation, to ensure that all inventory are recorded in financial statement are rightly belong to the company. Completeness, to ensure that all inventory transactions that occur during accounting period are included in the company balance sheet. Cut-off, to ensure that sales and purchase are properly recorded in the current period. Accuracy, to ensure all inventory transactions have been accurately recorded with the data provided at the exact amount and value. Realizable value, to ensure that the valuation method used to estimate cost of inventory is used appropriately. Lastly, classification, to ensure all the inventory must be properly classified by the management.
There are three main concepts for inventory and warehousing cycle. The first one is payroll cycle. Payroll cycle is the list of tasks performed while processing payrolls when we pay employees for a set period or on a given date. The second one is payment cycle. Payment cycle means the monthly period from the date you pay in any month until the date you are due to pay the following month. Collection cycle is the set of processes that begin when a customer purchases goods or services and ends when your business receives payment in full. Relevant accounts and transactions involved in inventory and warehousing cycle is, for payroll cycle, they have payroll expenses account, payroll accrual account, and payroll withholding account. For payment cycle, bank account, purchase account, creditor account, and expenses account. The last one is receivable cycle. They have account receivable, bank account, and inventory account. These are the documents involved in the inventory and warehousing cycle. The first is raw materials. It represents the cost being used in the production process. Direct labor such as salaries and wages is used to process the raw materials. Manufacturing overhead or other costs needed in order to process the raw materials, for example, utilities expense. And if these three documents are still in process at the end of the accounting period, it will stay as work in process. If otherwise, it will be recorded as finished goods. After it being sold, it will become part of cost of goods sold.
Next is internal control in the cycle. First is existence, proper segregation of duties and physical safeguard to prevent fictitious inventory, and use pre-numbered and or properly approved receiving reports and material requisition for inventory transfer. Second is completeness. Completeness is all purchase and requisition, order, report, and vouchers are pre-numbered and accounted for. Next is classification. Any raw material requisition and production data used to classify inventory into raw materials, work in process, and finished good. Accuracy. Accuracy is reviewing cost accumulation, standard cost, and variance reports by a person of appropriate level. Right and obligation. Recorded inventories must be supported with suppliers' invoice and good received. Next is cut-off. All receiving reports and delivery notes should be processed daily. Last but not least, realizable value. Periodic or annual comparison of goods on hand with perpetual inventory records.
Assalamualaikum. I am going to explain on test of control. So the existence for this test is for auditor to observe and evaluate proper segregation of duties and test procedures for transfer and issuing inventory. Secondly, for rights and obligation, the auditor has to check recorded inventory against supplier invoices and goods received notes. Thirdly, for completeness, the auditor has to check sequential controls over purchase requisition, purchase order, receiving report, and vouchers. Then they will have to test the control procedures for consignment goods. During cut-off, the auditor has to check dates of receiving reports and delivery notes to dates to record the inventory movement in perpetual inventory records. And to ensure accuracy, the auditor has to examine and test procedures for taking physical inventories, accumulating costs, and developing standard costs. Then, for allocation and valuation, the auditor has to discuss with management and test procedures for identifying obsolete and slow-moving items. And lastly, the auditor has to check the classification of inventory is in compliance with accounting standard and the company accounting policies.
My name is Ashani Binti Azhari and I will explain about analytical procedures and its possible misstatement in inventory and warehousing cycle. First, compare current year manufacturing costs with those of previous years, which is variable cost should be adjusted for changes in volume. The possible misstatement for this analytical procedure is misstatement of a unit cost of inventory, especially direct labor and manufacturing overhead, which affect inventory and cost of goods sold. Second is compare unit cost of inventory with those of previous years. The possible misstatement is overstatement or understatement of unit cost, which affect inventory and cost of goods sold. Next is compare extended inventory value with that of previous years. The possible misstatement is misstatement in compilation, unit cost, or extension, which affect inventory and cost of goods sold. The analytical procedure is compare gross margin percentage with that of previous years. The possible misstatement is overstatement or understatement of inventory and cost of goods sold. The last one is compare inventory turnover, which is cost of goods sold divided by average of inventory with the previous year. The possible misstatement is obsolete inventory overstatement or understatement of inventory.
Assalamualaikum. My name is Nurul Zahani and I'm going to explain on substantive tests. So firstly, for existence, the auditor will have to select sample of tag number and identify the tag with the number attached to actual inventory. Then, the auditor also have to observe whether the movement of inventory takes places during the count. Secondly, for rights and obligations, the auditor is inquired as to consignment or customer inventory included on client's premise. The auditor also has to be alert for inventory that is set aside or specially marked as indications of non-ownership. Thirdly, for completeness, the auditor has to trace items from the counts into client's inventory record for sufficient details. And the auditor also has to observe whether movement of inventory takes place during the count. while for cut-off, the auditor has to record in working papers for subsequent follow-up in the last shipping number used at the year ends. Then, they will have to select samples of goods received note from immediately prior to year end. To make sure the accuracy, the auditor has to recount clients' count to make sure the recorded counts are accurate on the tax, and then compare physical counts with perpetual inventory records. For allocation and valuation, the auditor has to trace items of inventory in inventory sheets back to original purchase invoice. Then ensure that inventory is stated in the accounts at the lower cost and not realizable costs. And lastly, for classification, the auditor will have to examine inventory description on the tax and compare it with actual inventory for raw material, work in progress, and finished goods. Then, the auditor will have to evaluate the percentage of completion work in progress.
The test of balance have 3 phases. First phase is identify client businesses affecting inventory, set terrible misstatement, and assess inherent risk for inventor, and assess control risk for several cycles. And second phase is design and perform tests of controls and substantive tests of transaction for several cycles. In the last phase is design and perform analytical procedures for inventory and design tests of details of inventory to satisfy balance-related audit objective. The balance-related audit objectives are existence, whereas inventory as recorded on tag exists. Completeness is existing inventory is counted and tagged. Accuracy is inventory is counted accurately. Part of valuation and allocation assertion for account balance. Classification is inventory is classified correctly on the tags, valuation and closely related to presentation and objective. For cut-off, transactions are recorded in the proper period. For realizable value, obsolete and unusable inventory items are excluded or noted. And lastly, for the rights, the client has rights to inventory recorded on tags.